Well, good morning to the West Coast and good afternoon to the East, and actually good morning to the Central. My name is Brad Uthridge, and I'm the Chief Marketing Officer for the Center for Tax Strategies and Resources. We're glad you're able to join us today. We're going to have some fun talking about topics that can be really critical to your business. We're going to spend about 30 to 45 minutes together. If you look at your screen, you'll have an opportunity to submit any questions. We'll do our best during the webinar itself to answer those questions while our main speaker is talking, and then we can kind of address the ones that we didn't get to toward the end. The two folks that we've got up there on the screen besides me is Simon Singer, who's the founder of the Center for Tax Strategies and Resources. Simon's been in our business successfully since 1966, written a bunch of business bestsellers, is in the top 1/10 of 1% of all advisors in the US. And is a heck of a lot of fun. And on top of that, he's also the National Humanitarian Award winner. And I get $4 from him every time I bring that up. On the other side of the screen is Steve Pasek. Now, Steve Pasek's our primary speaker today. Steve's a CPA and also has his Master's of Taxation. He's the founder of Pasek Public Accounting in Virginia. I'm having a whole lot of fun having the honor of introducing Steve because I've had the good fortune of working with him with multiple clients over the last, it's been about 9 years, Steve, since first put cases together. We not only have done business together and brought him in as counsel in the U.S., but we actually did a couple of cases in Guam. Steve cut his teeth in the business at KPMG as a senior tax manager in the Virginia office. And on top of that, he works with everybody from successful startups to Fortune 500 companies. One thing that I will tell you about Steve from personal experience is I call him at strange hours because I'm around the country. Steve almost always picks up the phone, and if not, I get a return call right away. And I know he tells his clients the same thing. We're going to talk about how not to lose a client at the hands of a creative CPA. Steve's going to give some of his insights and his top 10s and take some notes. I think you're really going to enjoy this. And then we'll tell you a little bit about an upcoming event we have. For those of you not aware, Center of Tax Strategies and Resources have our virtual academy coming up here on the 17th, 18th, and 19th of August. So we'll give you a little bit more information on that. With that, I would like to turn it over to Steve.
Let me interrupt a second. I'd like our audience to listen to what Steve is saying as a means of being able to enhance your service and the size of your practice by using tax savings as a vehicle. You don't have to be an expert in taxes. You just have to know who to call. Steve, would you take over, please?
Absolutely. Well, thank you, guys. As Brad said, we're out of Richmond, Virginia, have clients in all 50 states, so we're very familiar with all the states that are on this webinar, as well as 65 countries. We're going to talk about some big things here. For those of you who are my age or older, you'll all remember David Letterman, so I kind of made a little fun with this. You know, CPAs were all exciting. You will see that I'm a Sixers fan, you know, so no jokes about the Sixers, but we're going to talk about big things because what I've found in my 30 years of practice is that if you're not bringing these ideas to your clients, somebody else is. And if you want the real good clients, you have to bring value. And sometimes that's going to mean not something you're bringing to the table, but that something that someone else is bringing to the table. And the biggest thing to bring to the table is obviously saving dollars. Everybody does that. I've worked with Brad, like you said, for 9 years. We brought some major dollars to clients. I mean, hundreds and millions of dollars to clients, individual clients. So, and we're going to go through one example as we get through this. But as I kind of go through and say, what are the major things that I'm going to bring to my clients or a new client that I'm sitting in, and I can almost promise you 99, and you never say never, best, always, whatever, but one of these things, your prospect is not going to be well in tune with or saving enough or getting enough tax deductions. Then it just expands from there, because once you open up Pandora's box, I will tell you that you just get opportunity after opportunity after opportunity, and they say, man, you're my hero. You brought all this to me. Somebody else was sleeping, at the wheel. Now, with that said, the first thing that I always go for is the tax deductions. So if you can get a tax deduction that goes 100% to your owners because they don't have any employees, okay, or the employees are underneath, a term of which they haven't met the qualification tests, you go for their retirement plans, because I have not met one client who has saved enough for retirement. And we always ask that, like, have you put enough of your money aside for retirement? No. So that's where we always start, because we get a tax deduction, a major tax deduction, and then we go through and allocate most of it, or if not all of that, to them. Now, I will say, when you do a retirement plan, you always run the numbers first before you bring the idea to your client. Because if you have more than 75 or less than 75% of the benefit going to the owners, you don't want that idea. Okay, you might as well pay the tax and be done with it. Okay, and I know you're all going to say, well, that's 43% tax, blah, blah, blah. It works, trust me. Okay, so if you got 75% going to the owner or more, it's a good thing to do. Now, there are tons of different retirement plans. They're qualified and they're non-qualified. So what's the difference? So one, in my opinion, one you can be discriminatory against and choose and pick which key employees you want involved. One, you've got to include everybody. So you start with 401ks, you've got the match, you've got the employee deferral. You can put a profit sharing plan on top of that and have it as one plan. You've got the SEPs, the simplified employee pension plans. Get a big contribution there. You got your Roth IRAs, and you say, all right, well, the guy makes too much money or a woman makes too much money to do a Roth. Well, then there's other products that you can do that are just like Roths. And I am a believer in whole life insurance. And CPAs either love it or hate it. I love it. I've got 7 of them myself, and get that tax-free earnings, over the life of those policies. You can go traditional IRA. You can go executive bonus plans. Pick and choose which key employees you want. And then you can go, like I said, to the whole life plan. But you're planning all this out, and if you do it in different vehicles, whether you've got a C Corp, whether you've got an LLC or an S Corp, you can pick up a deduction, or you get at least the deferrals. And sometimes, with different non-qualified plans, it can be tax-free. So the key there is, and literally, if you only take one thing away from this whole presentation, and just take this slide, put it on your phone, bring it up as you're talking with clients, go from there, because one of these is going to work. So you say, all right, well, now client has put plenty aside for their retirement. Never happened, but let's just say that's the case. What else you got? All right, well, estate planning. If we have a change of elections this November, it's very likely that the current estate exemption of the 11.58 per person or 23.16 million per married couple is going to go down drastically. So how much is drastically? We're all talking about $3.5 million, back to the era that it used to be years ago when I didn't have as much gray hair. Okay, so now's the time, 2020, to be able to start gifting and putting things in place, like we're going to talk about later with, you've got Charitable Remainder Trust and all that, with your estate planning. You put that gifting in place now and basically transfer your client's net wealth, estate tax-free, I should say, okay? All of it's got to be done, but just kind of know that it's very, very likely that the estate exemption is going down dramatically. Are your clients' wills current? I would say 90% of my clients are not when I meet them, and we just kind of insist. And again, this has got nothing to do with what your products are that you're bringing to the table. You're being that valued advisor, and that's why CPAs are called trusted advisors, because we think about everything. We don't just think about what tax return we're going to save for them at that time. So make sure their wills are up to date. Now, that will lead into other discussions of, do they have enough life insurance to pay for their estate tax? Do they have enough key man insurance in their company if they were to pass? What goes on with all the buy-sells and who gets what and all that? So it's going to lead into things, but you bring it up, as I kind of call the back door, and show them that you're cared about their overall well-being, not just what you have to offer or sell or make money on. I'll tell you that I give away hours and hours a day of free service to build relationships, that what comes around goes around. So understand that, and I'm living proof of that. I never thought I'd be where I am today, and it's about bringing in guys and saying, look, so this guy's going to make a ton of money off it. Great, good for him. The client won first, and if the client wins, ultimately everyone wins. And so the client's got to do that. So then you say, all right, estate plan's all good. Their estates, they're under the exemption amount. They've only got $4 million of net worth. So him and his wife, they're fine, blah, blah, blah. Well, but you know what? My prospect or my client owns a piece of real estate. Well, back in eons ago, no one was doing this, but we have cost segregation studies. A cost segregation study on that piece of real estate allows you a huge tax deduction catch up today, okay? And it's got, you never say no risk, but the IRS prefers you to do these because you're doing it on a depreciation method in which they would prefer. What's happened is they said, okay, you have a business building, it's 40 years old, 40-year depreciable life. And we've all fought for years saying, the building's never going to last 40 years, that I'm going to have it, and I need a more economical way. Well, they've allowed us to basically componentize the pieces of the building, bathroom fixtures, security wiring, different type of flooring, fountains, smoke detectors, all this other stuff, and componentize it and get it into 5, 7, and 15-year property instead of 39-year property. Okay, well, what that does is that increases your depreciation, which then takes away your taxes that are due. A real life case that we're working on right now with one of Brad's clients is bringing them $180,000 of cash. So tax savings, cash to the table. That's not tax deduction, that's cash savings in year 1. Okay, now if they can't use it all in year 1, we can carry it forward and you're gonna use year 2. But the other person was sleeping at the wheel, and this advisor brought it to the table and said, hey, look, we got an opportunity. We just got to know where we can get this done. Well, Brad and Simon's team brought me in. We got it all done. And this advisor is looking like a hero. Hopefully he's on this webinar because he's done a great job.
Steve, can I cut in a second? You mentioned something to me a couple weeks ago when we were talking about cost segs. Didn't they used to be like outrageously expensive? Wasn't it kind of common to see a $30,000 or $40,000 tab for that? And how's that affected?
Even more than that. I mean, when I was with KPMG, we were doing these, and this was a while ago. I won't say how many years ago, but more than 20. We would only do them if there were, $20 million building, and the plan started, it was like $100,000 or more. Now you're looking at, you have to have a building worth over $1 million. Okay, just kind of give it to you. Well, what makes sense? Don't do a rental property for 250 grand. It'll never benefit. The costs to do this study will outweigh the benefits, and you never want to bring that to a client. But if you have $1 million building, not including the land, so it might be $1.5 million, and $1 million is the building, and you have it for 15 years or under, sometimes 20. It all just depends. You got to look at it. And they're showing a profit on their Schedule E or in their 1065 LLC or on their single member LLC, you should be looking at this, and you should be seeing, and you just look at their depreciation schedule, and again, you don't have to look at any of this. All you need to do is, like Simon said, hey, I got an issue, who do I call? And you pick up the phone and you call Brad or you call Simon and say, look, I got this issue, get your guy to look at this. And we run the numbers to see if it's even feasible before we even try to charge anything, because I'll tell you that half of them end up not being feasible, and we just don't charge for that. Relationship building. So the client loves that. So, and we don't charge a percentage. We're not consultants, we're CPAs. So we charge an hourly rate of what it costs to do the job, period. Okay, but they're not $100,000 jobs anymore. They're anywhere between 15 to 25 on normal, 25,000, 15,000 to 25,000 normal. So, but it requires a lot of work.
Well, then the great news is that if the numbers don't make sense for the client, they don't write the check and you don't do the deal, but nobody's writing a check up front for it.
Right.
So it just makes a ton of sense. It's either a good deal or it's not.
Right. And we bring it to them and we say either your guy did a great job or whoops, we got this that we can fix now. But just remember the $1 million rule. We've got a client we're looking at now with 41 properties, I think it is, and 2 qualify. It's too small. But and there's other rules in order for the use it, and we can go through those. But it's taxing, and you've got to be active versus passive, and so it's not just like, hey, I got a building, let's take care of this. Well, we're going to go through the things while we do the numbers and say, does your client do this, 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 and this, to make sure that all the good and bad and ugly comes out at once. And if that all works, I will tell you, you look like a hero, because the other person missed it. Going down, this is how I can talk for 30 minutes on one slide. Change of residency. We do this all the time. Being that we've got clients in all 50 states, we're constantly looking at especially people from California moving into Nevada. Now, I will tell you, I say, watch the rules. Everyone thinks that they can just go buy a or lease a 1-bedroom apartment in Vegas or outside of Vegas, and all of a sudden they're a Nevada resident and they have zero, state income tax. That's not true. You have to have your voter registration there. You have to have your driver's license there. You have to get your mail there. And most importantly, and this is where everybody fails that thinks they're smarter than the system, because this has been around for God knows how long, okay? You have to be in that state 183 days or more. So this is not, I'm gonna go vacation in Vegas for a little bit, and I'm gonna go vacation down in, Texas, and all of a sudden everything's exempt. It's not, okay? So, but there are plenty of times where I had a client of mine in Virginia who wanted to move out to Nevada and said he's got a lot of investment income, and that's what happens is your investment income gets pulled over into that state and it's tax-free. But we literally keep a calendar of how many days he's in that state, because let me tell you, the states will challenge this, and you better have that documentation and have it all buttoned down, or you're going to lose 10 times out of 10 times. And I've been in those audits, and I've gone to my client saying, I cannot represent you in this because you lost. And I've walked into the meeting and said, we give up. All right, this guy did not do this right, or it's a new client, stuff like that. So everything's got to be documented right, and don't fall asleep at the wheel on that. Check in with your client. Have you been there? Prove it. Now, how do you prove it? Run your debit card through, run your credit card through, show the IRS, not the IRS, show the state you've been there. And that's how you do it. And you have a personal card or whatever, and you just run it through. You go to an ATM, you go to the bank, you make a physical deposit. There's ways to demonstrate that you've been there, okay? We can go through all that later, but I'm telling you, you can save on average 6% of your client's income there by moving states. So that's always a great thing. One of the things I brought up before about the estate planning was a charitable remainder or a lead trust. These are pretty cool, and they're coming back into more effect now because people are able to gift more to get it out of their estate. You get a charitable deduction today. You are able to change the beneficiaries, and you put this into an irrevocable trust, okay? What's cool about it is that you get an income stream for the rest of your life, and you decide what that income stream is, okay? Now, it's gotta be 5% or more in most trusts. I won't say all trusts, but most, all right? So there's a lot of planning to do with this, and you need an attorney to create the trust and all that other stuff. But what I'm saying is you get a charitable deduction today. So I've got a client doing this right now. He's putting $1 million into the trust, and he's doing that through different investments that he has, and he's a very charitably inclined, and he's moving the $1 million over. He's taking his income stream back, so he gets a $900,000 deduction today, because that's the present value of the charitable deduction, taking into account the income stream, okay? Gets a $900,000 deduction today. He decides who the beneficiaries are. He gets his income stream for the rest of his life, which, by the way, it's taxable, but you can donate that in that year so that you don't have to pay the tax on it. You donate the income stream. Now you've got to watch about percentages of adjusted gross income and limitations and all that, and we can get into that as you do this. But I'm having a lot of success with people saying, look, I've got all this net wealth built up, and I want to do this before the end of the year to make sure that I can transfer this over before anything other happens and use up the charitable deduction. So you've always got that, that's available. Another one, 6.
Steve,
yeah.
Steve, can I interrupt for a second? Once you've given that asset away, if there is appreciation in that asset, which is typically the type of asset that you want to give to a charitable trust, you also defer or eliminate the long-term capital gains and eliminate it from estate taxes as well. Am I right?
Yep, absolutely right. That's a good point. So if you donate a piece of real estate and you paid $100,000 for that piece of real estate and it's now worth $1 million, you put the real estate into the trust, you avoid paying the tax on that $900,000 gain, and you get a charitable deduction.
Yeah, so you get a $900,000 deduction, you get $300,000 of tax savings on the long-term capital gain, and even if tax rates stay the way they are, I'm talking about estate taxes, you're going to eliminate the 40% estate tax rate. You put them all together, you're between 80 and 90% being funded by taxes that you and or your family otherwise would have paid.
Correct. That's absolutely right. And remember, in order for you to get an income stream, it's really beneficial for you to sell real estate in there into liquid assets so that they spin off dividends that you can take the cash from. So it's just, and the flexibility, I think, is great and huge because you're able to change your beneficiaries. So if somebody upsets you and you say, well, I put them down as a beneficiary or one of the 10, well, they get nixed off, you know? I've had clients do this that get buildings named after them because they put these in place with one beneficiary and, you know, they have that, you know, at their name. So you're able to enjoy the gift during your lifetime instead of after your lifetime when you've passed and you haven't, you know, your family sees it, but, you know, your alma mater may love the fact and you may love to see that during your lifetime instead of after. So it's just a great thing that we're seeing a lot of people start to consider a lot more. Been around for a long time, but we're seeing more and more of it. Golden parachutes. What I'll say on these is this is more everybody's world and your world than it is my world. These are your non-qualified plans that I call Brad in and I say, hey, Brad, I got this guy that's making $10 million a year and I need some deductions and we've got a C Corp and I need to be able to put this through whatever, whether it's a W-2, whether it's whatever. And so know those are out there and they're very allowed. There's cut and dry plans, but that's when we bring you guys in and that's when you're able to help us and we kind of feed you. Bonus depreciation. So bonus depreciation is 100% through 2022. Okay, what does that mean? You say, well, Steve, we can get Section 179. We all know of what Section 179. 179 means that you can take an asset, call it $10,000 asset, expense it all in the current year. Okay, there's limitations on that. You know, it used to be 250 grand. Okay, however, the biggest limitation is, forget that limitation, is that you can only take Section 179 up to your profit. So if I have a company that is in a loss and I've lost 100 grand, I cannot take Section 179. Okay, so that's a limitation. Well, bonus depreciation was put in place to spur the economy and says, hey, wait a minute, you don't need a profit. So if you want to, you've got a $100,000 loss and you got $50,000 of assets you bought, you can write them all off in 2020, 2021, 2022. So you get the full tax benefit of buying those assets in the year. Now there's qualifications and stuff like that. So just don't go out and buy a brand new Lamborghini and think you're going to put it in place and get 100% limitation. There are qualifying assets. There's things of that nature. But the piece is I've got lots of clients that are manufacturers, doctors, physicians that are needing those huge MRI pieces and all that. And we can write it all off in the current year. We can finance the piece of property. Okay. So we're paying a monthly payment and then, but we get the full write-off in the current year. So we are way ahead cash flow, okay? And the interest is deductible also, by the way, on when you finance that piece of equipment. So, you know, we've gotten all that. So bonus depreciation has been a really good thing. Now I say through 2022 is 100%. It goes down percentage-wise after that. We still have it for a while, but you know, it goes down from lower than 100%. Exit planning strategies. This is an area in which is your area again as well. I tell clients every time they start a business, or I ask them, what's the exit? Are we going IPO? Are we going to sell? What if you die? You know, what's going on? So it's the infancy of it, but it's like I always say, get the bad and the good, bad, and the ugly out right away. So you have to look at buy-sell agreements. Well, those are funded by products that you guys do. You need to do key man insurance. Well, that's you guys again there, okay? You need accounting reviews. You need disability insurance in case one of your founders is not able to get up or key people. So you need that, that's you guys too. You've got to maximize the deduction. So when you're buying the business, there's certain rules of what you post into goodwill, what you post into equipment, how far you can depreciate it and stuff like that. So you always got to ask when you're buying what the issues are, but then also when they're selling, you want to position them so that you have all of their call it ducks in a row to be able to say, we've considered all this and this is where we go. And you visit that every couple years. Are we still on target for this? What's the plan? Because I've had too many experiences where these products, you know, as you guys call them, have not been in place, and the worst case happens. And I'm sitting with usually the spouse of the other, and they're saying, what happened? Why didn't we bring this up? And then as an advisor, even though it's got nothing to do with tax, I bring up my notes and I say, you know, guys, we brought this up. You know, they didn't want to do this because of cash flow, or we were going to get to it, you know, but I never want the finger pointed back at me or my firm and say, you guys should have thought of this. Well, we did, and we brought it up. Okay, so again, the trusted advisor brings up things that may not get them paid right away, but ends up working in the long run. Another way that you provide value and you do not lose that next prospect, I bring this up all the time. Refinancing your business debt or your you know, home mortgages, home credit lines, business lines of credit, have those resources available. I've got resources across the country with different banks, depending upon where the people are. You know, what do they always say? There are 4 trusted advisors in everybody's business court that you must love and bring to them to your grave. That's your attorney, your accountant, your insurance man or woman, and your banker. That's the 4 foundations of a house. And if one goes down, the whole house crumbles. So if you don't have those 4 in place, you're looking to be that person for that client. So, you know, when you bring up the fact that, well, let's refinance, and you just saved them, you know, $10,000 a year, well, and all you did was make a phone call to the banker because you've got the resources, you look like the hero, you know, and all you did was think outside the box and look out for your client. The other thing that I always find that clients, and there's a lot of products out here versus 529 plans, but educational plans. Nobody's put aside enough, well, not nobody, never say nobody, right? Most clients have not put aside enough for their education for their kids, period. So they're always looking for ideas, whether it's a 529 plan, whether it's a product, you know, that can do better than a 529 plan based off of that state's, you know, sponsor. It's another whole area, but look at that for your clients to be able to put aside some money to get all that done. So that's like the top 10, but I did want to bring up another bonus idea if I've got a few more minutes. I know I'm at 30 minutes, guys. There's a
No,
brand
you're
new.
good.
All right, good. This could be huge, although Texas announced that it may not likely happen. But basically, Texas has a case out there with the Supreme Court that is challenging the constitutionality of the net investment income tax. If you all remember what that tax is, it's an extra tax that we all pay on whether it's real estate, whether it's, you know, other investments, and they're saying that that is not constitutional. And if the Supreme Court favors this decision, in whether it's the fall or whether it's going to be the spring, there are going to be huge amounts of refunds that are due for these clients. And sorry, I got my dog in the back. And if you bring this idea to your client, like I've got clients that pay over $100,000 in net investment income tax. Well, those clients are going to pay, call it $1,000 for an amended return, and you just saved them 99 grand. It's just an awesome opportunity. Keep your ears open for that, so that, you know, you are able to bring them that idea.
Sure.
Just as a final note before I kind of sign off here, ACG's got that whole tax questionnaire, reduction plan questionnaire. Start with that. You know, there's so much information and questions in there that'll bring you opportunities to be able to get your clients to, you know, save tons of money.
Hey, Steve, I've got a question for you. You had talked to your dog before this webinar and told him you were only going to be on 30 minutes, and then
I'm texting my team to get him out of here, you know? Sorry about that.
Well, actually, mute yourself for a second. We'll go to questions. I want to go up to the next slide a minute, and then we'll go back and readdress some of the questions that came in. Todd, can you change the slide for us here a minute? And Steve, if you got to get your dog, go ahead. But we want you back for the Q&A. Okay. If you want to learn more about the tax reduction plans, join us at the Center's Virtual Academy. As I mentioned earlier, it's August 17th through 19th. starting at 8 a.m. Pacific time and ending pretty close to 3 p.m. What you just saw was kind of a snippet of the level of detail and the caliber of the professionals that we bring in for these events. It is the first time we've done virtual, but we're really excited about it, and we've had a really an excellent amount of interest in it. A lot of people sign up for it. If you want more information on the Academy, please call 877-258-2837. And if you get a minute, go ahead and check out our website. It's www.yourctsr, Center for Tax Strategies and Resources, yourctsr.com. And there's a tab in there also. There's a little bit of information about us and a little bit on the Academy, and you can actually register on that site. Okay, Simon, anything you want to add to that part? If not, we'll go into a couple questions. Oh yeah, why don't you talk about our Superstar Academy faculty?
Well, we've got 3 tax attorneys that are going to be speaking, each one charging between $600 and $800 per hour. And we're talking about 21 hours worth of the highest level education you can imagine. Bruce Givner is a nationally recognized tax attorney, and he basically gives you things that you can implement the day after the academy is over with. Joe Strazzeri is the creator of something called the Southern California Institute. And they have a program called the Laureate Program, which is a think tank and a training venue for CPAs and attorneys. Vince Dodona is the all-time leading production leader for Guardian Life. Walt Dallas is a JD with an LLM in tax. We'll also be talking about tax reduction plans in addition to Steve. Dr. Jeff Galpin, you'll find this interesting. Jeff Galpin was the lead researcher on the HIV virus, and he is in the same position with regard to this coronavirus. And he's going to be talking to us at 4 in the afternoon on one of the days, I think it's Tuesday, basically eliminating all the political rhetoric and basically sharing with us where we're at, where we think we're going, how dangerous this is. He'll be available to answer questions. There's going to be experts on ESOPs and marketing. And let's see, Todd Martis will also help Walt Dallas on the tax reduction plans. Dr. Vicki Rackner is the chairman of our Doctors Academy of Economics, kind of sharing with people how doctors assimilate information and make decisions. And I can tell you firsthand that while I didn't realize what was going on while I was working with a few doctors, everything that she said would have saved me a god-awful amount of time and made it significantly more attractive for us. Mike Zelch is going to be sharing with us the different kind of retirement plans, how you can make all of these things available in your practice. Curtis Cloak, most of the people on this webinar know about Curtis and his preeminent expert in maximizing retirement cash flow. The bottom line is the resources and Center for Tax Strategies and Resources is really the operative word. It's basically talking about the fact that we can't know everything about everything, despite the fact that we try to impress our prospective clients that we do. We just don't. I'm now in my 54th year, and I will tell you, as time goes on, I get the feeling that I know more and more about less and less, and pretty soon I'm going to know everything about nothing. We need help. We need credibility. We need resources, and that's what this study group on steroids does. And just remember, a little help can make a great big difference. If you're making $150,000 a year right now, we think with our help, if you'll listen to us, that we can get you up to $300,000. And if you're making $250 a year, we can probably get you to $500,000. And it's not that we're smarter, it's just that we've got this years and years and years of experience where you can benefit by the mistakes that everybody on our dais will have made and how to avoid those things. And we'll also spend a lot of time talking about strategic alliances and how they can make a difference. So Steve's here right now, basically assisting us because of the fact that we have created a strategic alliance. He's not doing it out of the goodness of his heart. He's doing it because it helps his practice. If we know how to do it correctly when it helps his practice, it helps our practice. Bradley, why don't you take over?
Yeah, good. Thanks, Simon. We've got some questions for you, Steve, that came in. A couple of them we've been able to handle. They were relatively simple. Great question here from John Martin about how would you suggest opening a conversation with a business owner client. It just says how to open a conversation to have an opportunity. I'll take a piece of that, and Steve, if you want to add to it, because you've created a lot of opportunities that you brought me in on that we did work together and vice versa. Usually with the business owner, I mean, the whole reason behind the Center for Tax Strategies and Resources is we firmly believe and have proven that leading with tax saving reduction is a huge, unbelievable, easiest way to be able to get in front of a client under favorable conditions. So, you know, we make it a point never to speak ill of the existing counsel of any of the clients that you have or our clients that we have or their CPAs or tax attorneys. But we have assembled Steve as part of the faculty because his practice specializes in finding those things that have a tendency to be missed. He is a specialist. He's a surgeon when it comes to tax reduction savings programs. So, you know, if I was looking to open a conversation with a business owner, it'd be as simple as saying, look, one of the things we do is make sure that we find every efficiency within your current planning. One of the things that we suggest you do is we look at a couple of years of your tax returns, both personal and professional, your corporate returns. I have a expert, nationally known expert, who will do a review, come back, tell me and tell you what type of savings or opportunities that they would be able to uncover and what it would cost to get those things done. What I really like about that is the client's not writing a check and rolling the dice. When I first talked to Steve, Simon and I talked to Steve about coming on board as part of the faculty, said this is the approach we favor, and he said, I've been doing that for years. That's how I've got my best clients. So, you know, in other words, let your work do your speaking for you. And Steve, anything you want to add to that, or Simon?
Only thing I'd add is I always ask, are you happy with your current CPA? Remember, we're one of 4 advisors, right? The foundation advisors. If you've got a relationship with if your client has a relationship with the CPA, don't bring me in, because the best thing they can have is that one of those 4 advisors be a great, and sometimes they're like, well, can I have my CPA call your guy? Absolutely. You know, there'll be no charge, and let's see, make sure that the client is protected. And I do this all the time, help out other CPAs, you know, in the country to make sure, but I always ask, well, are you happy? And they're like, well, he doesn't pick up the phone after 5:30. He doesn't call me, you know, he doesn't return my calls, you know, for 4 or 5 days. I mean, if I haven't hit you back in the hour or, you know, 2 hours max, I'm either dead or I forgot. So, you know, that's the way you keep clients. So are they happy with their CPA is what I would add.
I think what I would do, Brad, is ask them what their largest expense is. And, you know, they'll beat around the bush. They might say my spousal support, my child support, my home mortgage. But the reality is, if you're talking to the kind of person we think you ought to be talking to and have enough confidence knowing that you don't have to know everything, they'll pretty soon get around to admitting that income taxes are their largest expense. And then I might say to them, well, we have a $26 trillion deficit. Do you think that taxes are going to go up or taxes are going to go down? Because the one thing we can count on is that Congress is never going to reduce spending. So where's the money going to come from? And the answer is, it's going to come from the top, you know, 1 to 10%. And that's who the client is that we're looking for, a high level client that is going to be paying significantly increased taxes. So are you, would you like, do you have enough confidence in your existing advisor to get a second opinion? You know, we don't have to say that their advisor screwed up. All we have to do is be able to open the door. If you open the door, we can show you, along with our strategic partners, just how, in fact, you're going to be able to bring a significant additional value. When you bring additional value, you increase budgets. When you increase budgets, you have more that they can put into assets under management, or more into their pension plan, or more into their insurance structure. It really doesn't matter. You've been a valuable asset. Go, Brad.
Excellent. Okay, one of the questions that came up, it'll be a quick answer, is we want to know what ACG is. It's consulting, it's Advisors Consulting Group, which is Simon's practice and his team in Encino, California. Are the tax reduction plan questionnaires available to us? Chase, they are available to members. It is a patented piece. So what I would suggest you do, if you haven't already registered for the Academy, go through the Academy. You'll find out a little bit more about why members come in and pay dues to become part of our group. And if they qualify, they get a whole lot of tools on top of all the relationships that we can help you bridge, such as Steve and Givner and everybody else that Simon mentioned a minute ago. So the answer is yes, but it's conditional.
Brad, what is the current pricing for the virtual Academy?
Members, guests can come in for $495, which I think comes out to based on your math, Simon, I think they make $15 an hour.
I think if you take 495 and divide it by the 21 hours of training, it comes out to about a little over $23 an hour. And let me answer the question right now. No, it does not qualify for continuing education because it's too expensive for us to go state by state in order to be able to get approval, in which case you might find that $495 became $4,950. So no, it's not, but I would be willing to guarantee you that you're going to probably increase the revenue that you generate by probably 10 times over what this the investment in yourself is.
Absolutely. And no airfare and no hotels and no standing at TSA checkpoints and all that. Okay, next question was from Anthony Schumann. And Steve, could you please repeat or put in the box the 4 advisors Steve mentioned? I'm not sure what that refers to.
Yeah, so the 4 advisors are your banker, your accountant, CPA, make sure they're a CPA, your insurance broker, and your attorney. Those 4 make up everybody's business house, and they've got to be strong, and you've got to bleed your soul to them. That's how they help you.
Excellent. Wild Bill Newton said there was no mention of 199A captives or conservation.
Yeah, we can talk about that. That's great. It's a great subject. You know, we all love that. That took the whole basis rules and made it basis simple. You know, when they brought out 199A.
Yeah.
So your 199A planning obviously is part of your protocol. I think you and I have had private conversations about.
Yeah, we always look at that, you know, because it's missed so often, but that's one of the things on our checklist. But you didn't want a 25 checklist. Letterman only does 10, and I gave you 11.
We appreciate it.
You know, in addition, and I also noticed on your menu, just because somebody is an S corporation today doesn't mean they're going to stop being an S corporation, but you might run a parallel business entity that's a C corporation alongside in order to be able to move some of the marketing costs and some of the non-professional costs into that C corp, which really only has a 21% federal rate as opposed to 37. And that's where 199A can come into play, because you can absorb some deductions that don't exist in an S corporation when you transfer them over to a C. And then there's qualified and non-qualified plans. There's 414 M and O things that have to be dealt with. But it's a process, and if you try to do it on your own, you're making a major mistake, and you and your family are suffering a significant reduction in what your income really could be. So, Bradley?
Remember, an LLC can choose to be taxed as an S corp with just a 1-pager election. Okay, so you can get the tax benefits of an S corp, but have the legal benefits of an LLC. That's a whole nother webinar, but you know, all these options are available when someone went geek all the way with their master's in tax that sits here at, you know, with jerseys behind them.
That's you, Steve.
That's me. I love this stuff.
Mike Schwartz had a comment about dementia that I'm just going to leave on the sheet there. Rashid had asked you to talk a little bit more about cost segregation, and unfortunately, I know we blocked some time for you on this, Steve. But if you want to do just one more little quick vignette on cost seg, like when again the best time to bring in a cost seg analysis and that type of thing, just a real quick shot on that, that'd be great. Yeah, I mean, like we're doing cost segs now for the 2020 year, so that we can plan it out appropriately. It's a no-brainer, guys. I mean, especially if you've got profit from the real estate entity. I mean, it is a no-brainer, and the IRS prefers it. So you're just doing and you're going to bring huge dollars. So $1 million of a building value, less than 15 years old, you know, so they can have it for a while. You know, we can still catch up and make a big benefit. Do understand that when you do a cost seg, please do not sell it within the first 5 years, because then it basically negates all the benefit you took. You're just going to recapture it all back, and you're not going to have a happy client. So I always ask my clients, you're going to hold on to this for another, you know, umpteen years, right? And they're, oh yeah. You're not going to sell it. But it's a no-brainer, guys. It's absolute no-brainer. You just need to have the resources of who can do it. We do all ours in-house, you know, with the engineers. We don't outsource it. We don't charge a contingent fee. We don't charge a percentage. I mean, you just have to know who can do it.
And I wouldn't throw out the words. I would gather the 2 years of tax returns and fill out the questionnaire and ship that over to us, and then we'll be able to figure out in 5 minutes whether or not there's a prospective opportunity there. Sometimes there is, sometimes there isn't. But you're not sitting there saying to somebody, do you have all the insurance you need? Or has anybody looked at the investments in your pension plan? Creating levels of differentiation is monstrously important, especially in this time of COVID and being, basically stuck in our houses where nobody's going into the office. But sales can be accomplished, engagements can be created, relationships can be created and expanded on. And that's the thing you need to focus on.
And the examples I gave everybody are not extraordinary. Like, you hear some of these things and, oh my God, that's 1 out of 1,000. No. These are everyday examples. I mean, this is just so routine. So it's not like I'm giving you out of the ballpark. I'm never going to see these numbers. These are numbers that are common.
Well, it's routine. It's routine for you, which is why we like
routine. Yeah.
Okay.
Last
question.
A big buck.
Last question we have time for. Somebody wants to know, I'm not even going to tell you who it is, if you have any real teams that you support.
Iverson is over there. Drew Brees is over there.
Okay.
Yeah, we got a few of them.
I was just trying
We do a lot of professional athletes as clients, so these are like things that I've acquired over the years.
I've seen them in person, I understand, but that's not what we were talking about. The last question that we've got for is what happens to the depreciation when you do cost segregation? So have they taken a few years of depreciation on the property to date? You do the cost seg, can you just explain the impact on that?
So we take what they've taken versus what should have been allowed with the cost seg. So if they've taken, $100,000 of depreciation, but the cost seg numbers say that through this date, this year, they should have taken $250,000 of depreciation. We do a catch up in the current year for $150,000 of a deduction. We catch it up at that year of what the cost seg allows,
Awesome.
Which is what the IRS would prefer. That's why you have the catch up all in 1 year.
Great. Well, listen, on behalf of the Center for Tax Strategies and Resources, Steve, thank you for your time. We're so excited to have you as part of the faculty, especially for the upcoming academy and all the cases that we've dumped on your desk in the last couple of weeks. We're really excited to have you as part of the team. Just again, a reminder to join us at the Virtual Academy, August 17th through 19th, starts at 8 a.m. Pacific, ends around 3. You can go to our website, www.yourctsr.com. There is a $4.95 investment to sign up. If you do sign up in the next 48 hours, which starts, by the way, at 12:50 Eastern, which is 1 minute ago, and you enter the promo code VLASP817. Todd, you're going to have to explain that one to me. I can usually guess. VLASP817. Enter that, you'll pick 15% off, which takes you down to, I think it's $420.75 or something like that. So use that code in the next 48 hours. If you have any questions on any of this, dial that number 877-258-2837, or you can email us if you prefer at thecenterteam@yourctsr.com, and we'll get back to you right away. On behalf of the center, Simon, thanks for hosting this. Steve, thanks so much for coming on board.
Thank you guys very much.
Thanks, Steve. Take care.
We will be in touch, Steve, and everybody stay well.
All right, have a good one.
Bye.